you have to be both left brain and right brain. That means you have to be creative. That means that you have to see value that is not staring you quantitatively in the face. You have to find value in growth. Maybe you have to find hidden assets. Maybe you have to think differently. My goal as an investor is to maximize my total IQ. Okay, let me define what my total IQ means. It's basically multiplication of two factors, my IQ and my EQ. So my IQ, when I look at different companies, is going to be different, right? Because I know maybe a lot more about Walgreens than I know about a gold miner. So my IQ is going to fluctuate. What I know about Walgreens is probably not going to fluctuate that much. But my EQ is going to fluctuate a lot of times with the stock price or with what something is happening in the company. So my goal is to maximize, when I look at the universe of stocks I'm looking at, I want to have the highest IQ and, as importantly, the highest EQ. But there is one trick. EQ cannot be greater than 1. So let's say your IQ is 150, but your EQ is 0.2, so therefore your total IQ is going to be 0.3, right? So your goal as an investor to figure out where is your EQ is the highest, okay? So for me, I realized my total IQ is the highest when I own high quality companies. And the reason it's important because it's a matter of time, because before something bad is going to happen to the stock you buy. It's just, that happens every other day. And if you remain rational, that means you're going to make right decisions, okay? So we made a decision a few years ago when we realized this, that our EQ is the highest when we own high quality companies. Therefore, we made it an absolute threshold. In other words, I will look at a company, and if I find that it's quality below my threshold, I stop. I don't even care what the price is anymore at this point. I just move on. I analyze the company, analyze the business, and what quality means to us. There are a couple of definitions of that, but let's talk about this for a second. So for us, quality basically business, balance sheet, and management. Okay? If those three things have high marks, that's going to be a quality company. The second thing we look for is growth. And then finally, we look for valuation. So my point is this, when we look at a company and it doesn't pass the threshold, I don't care about growth, I don't care about valuation, I stop. Because the goal is to maximize long-term return, right? And to maximize this return, if my total IQ remains high, I think the return in the long run is going to be higher as well. Right. So that's what we try to do. Think about Buffett. Buffett evolved from a Ben Graham kind of formulaic investor to a person who realizes that, Ben Graham probably would never have bought Coke because it was not statistically cheap. But there is a value in growth, okay? At the value conference, I'm saying there is value in growth because Coke has doubled or tripled, quadrupled its earnings. And there is tremendous value in that. So I think as investors, we learn probably a lot more from our pain than from anything else. So evolution to where we have a high quality threshold, that evolution came from a lot of painful decisions we made. And also another thing I would say that today's environment, macro environment, is very different than we ever had before, I would argue. We are celebrating 4% unemployment in the United States, or very low unemployment in the UK. But what we did, we realized that came at an incredible cost. We have incredibly low interest rates, huge budget deficits, and a huge amount of debt. So if people are celebrating today's great economy, realize at some point there is tremendous cost and there will be a price to pay for that. So therefore, another reason why we said okay, quality is absolute, because I think determining margin of safety for companies that look statistically cheap may prove to be very deceiving in a high interest rate environment. What looks cheap today may end up being very expensive. I think if your only strategy is looking for quantitatively cheap stocks, at some point in time, you will be competing against computers. And they'll be so much better at doing this, okay? So just think about everybody in this room is a left-brain person for the most part, right? When we are left-brain people, we are extremely logical. And if you're logical, 1, 2, 3, 4, that means that could be put in a computer formula, right? So therefore, at some point in time, there will be an algorithm that's run on Amazon Web Services that is going to be so much better than us picking statistically cheap stocks. You have to be both left brain and right brain. And the right brain, that means you have to be creative, okay? That means that you have to see value that is not staring you quantitatively in the face. that you have to look for things that, maybe you have to find value in growth, maybe you have to find hidden assets, maybe you have to think differently. Okay, and I think this is kind of a evolution of me as an investor, and I think most of us will have to evolve into this if you want to be competitive in the future.